And I wanted to start the lecture and thank everybody for attending. We have a really nice crowd. And just a quick disclaimer. All signals of trading opportunities provided both orally and written or electronically for educational and demonstration purposes only. Careful consideration of your financial position should be made prior to trading. Never risk more than 2% of your account. We are not a registered financial advisor, not a licensed commodity trading advisor. Now, today I'm going to talk about how to find low-risk, high-reward trading entries on the futures, forex, and stock markets, and really, and it's all going to be based on looking at ways to leverage volume profile, ultimately to create a really powerful market profile. Now, if you stay until the end, we will pull your email out. We're going to give you 1 month of our Options Alert newsletter for free. Just to show you how it works, the last newsletter, we closed NVIDIA for a profit of $150 per spread. That was a 50% return, and we put it in a new position to buy calls on Taser. Taser is the #1 company in the world that makes cameras for drones, and Trump is increasing defense spending markedly, and is put in a large purchase for drones. So we make specific we put in for specific entry targets, always with on limit orders, and I make specific exit orders also at a limit price. So you'll get a free month of Options Alert newsletter, which is doing really well, actually. And just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia, and I published close to 15 peer-reviewed articles in first-year journals, and I've been involved in the financial markets for over 20 years. And right line trading is the product of a decade of analysis of price action, market structure, and indicator algorithms. And really, the software is based on the mathematical modeling of closed systems, in which we determine what independent variables are required to predict future price movement in any given financial market. And then what we do is we put those independent variables into an equation and we optimize them. So it's all very mathematically based and grounded in science and not just in guessing. And it's one of the fastest growing trading systems on NinjaTrader. And I'm going to show you some of the things that other people trade, just very briefly, that just simply don't work. That's a picture of me. Everybody says to put up a really professional picture, but that's right after my son attacked me and messed up my hair and put my glasses upside down. But now you know who's giving you this webinar. And that's not beer. That's actually just a Diet Coke. Now, there's a couple of things that I wanted to say before we get into volume profile, and that is that 95% of all day traders who trade the market wind up going broke. They fund their account multiple times, and ultimately every single time they wind up losing money. They trade the markets for a couple of years unsuccessfully, and then they're gone. And each generation of day trader does no better than the previous generation of day trader, which is very unique in any really human endeavor. It seems like in every other field of science, like medicine, like architecture, chemistry, the success rate evolves in that each given generation learns from the previous. But this is a very, very unique business in that it doesn't seem that day traders use a trading methodology that evolves. I mean, we don't seem to learn from the last generation of day trader. And remember, the people who are teaching us are the people who taught us, who taught the previous generation, and the previous generation are the ones in which 95 out of 100% of all day traders were unsuccessful. And they continually trade the same thing that has never been proved mathematically to have any validity. So what we did at Rightline is we looked at a number of theories that had been out there, one of them being Fibonacci. And I'll start with Fibonacci really quickly. And what we did is we took Fibonacci levels, confluences, Fibonacci clusters, and we did 2 years of testing on them using market replay data. And what we found was that Fibonacci had no independent predictive value of determining how price is going to move into the future. Fibonacci levels broke or held very arbitrarily and randomly. Therefore, you could never accurately predict whether price was going to bounce or hold at any given fib level, making them totally irrelevant and totally unhelpful in increasing the precision of your trading. Now, you know Fibonacci was a mathematician who was around in the 1800s, and he created some elegant transformations and Fibonacci numbers. But actual Fibonacci, and there's so many Fibonacci advocates out there, but that's why 95% out of 100 day traders fail, because they're constantly wed to theories that just simply don't work. Fibonacci has never been rigorously tested mathematically, never been proven to predict future price movement. It actually doesn't. And the same thing with Elliott wave. We tested Elliott wave. I mean, I have books on Elliott wave and Gann theory on my shelf, in which I've waded through them and then tried to apply them to price movement on a financial instrument, whether it be the E-mini or bonds or crude oil or Forex or stocks. And Elliott wave simply just doesn't work. The other are oscillators. You know, oscillators give overbought, oversold signals. Everybody trades them differently. When the market is overbought, some traders continue to buy as the market moves up, using the method that if a market's overbought, then the bulls are firmly in control, and they're going to continue to buy. Others look for oscillator divergence, or they look for MACD divergence, and I think everybody listening knows how frequently divergent signals are overrun. So oscillators really, really do not help, and we have discarded oscillators in our main indicator package, and we just don't use them. Now volume is one that's extremely important and is valid, and how you assess volume makes a big difference in how you trade. There are only 5 elements in a chart that is created on every single formation, and the formation can be a candle, it can be an open, high, low, close, and that is volume is one, and the open, high, low, close of a candle are the others. So those are the 5 parameters that are plugged into every formula in order to derive an indicator, and there's only those 5. There's the open, high, low, close of a candle, and there's volume. So volume is an extremely important parameter in determining future price movement. Now, when you first start, you're unlikely to make $5,000 a day or even $5,000 a week when you start. And when I first started, all I wanted to do was to pay my bills and have a tiny amount of cash left over. I mean, you start with a very, very modest goal to cover your expenses and to really loosen up the financial noose you have around your neck, pay your bills, and make day trading a full-time job that covers all your expenses. But I really did decide I wanted to be a millionaire, and I had the drive and the dedication and really the obsession to achieve this goal. And I think that's the way that everybody should start, with this kind of drive, with this kind of obsession, and eventually you're gonna wind up being extremely profitable. The thing that you cannot do is take anything that you've been told for granted as being accurate, and anything that you're told as increasing the precision of your trading entries unless it's demonstrated that it works for you on a mathematical basis. And that's the most important thing, to be a skeptic and ask anyone who provides you with any kind of indicator or for any kind of trading methodology to show you how it works, give you all the information on it, and make sure that it works on a scientific level. And I'm telling you, you can use these skills to buy yourself a nice house, cover your expenses, take vacations. And here's the thing, and this is why I put the slide up, really to exemplify this. There's two groups of traders out there. There are the commercial traders, and then there are the institutional traders. The institutional traders are the ones that leverage the huge money. And it doesn't make any difference what kind of markets you're trading, whether you're trading the futures markets, the forex markets, or the stock markets. The huge traders create, the institutional guys create the trend. They create the direction that the market is moving. There's high-frequency traders, which are the institutional traders. They buy huge numbers of shares of stock or forex contracts or futures contracts, and we have to trade with them. The traders that we want to beat, and there's no reason why we can't beat them every single day, are the other commercial traders like us, the small guys, the guys that are counter-trend trading, the guys that are calling tops, calling bottoms. You're going to see from what I show you that those are the guys who we must force to pay our bills, must force to cover our expenses, and we have to force to give us their money. Because that's the group of traders out there that we have to beat. And if we don't beat them, they're the ones that are taking our money. If we trend trade, it's not the institutional guys, it's the other commercial guys that are, it's the large institutional guys. I'm sorry, if we trend trade, it's the other commercial traders like us who are taking our money home. And again, we cannot allow that to happen. Now, again, what we want to do is we want to find low risk, high reward entries without utilizing the indicators and chart patterns that you're likely to have been taught will work for you and are most likely a part of your trading methodology right now, and they fail because 95% of I mentioned of day traders fail. So what I wanted to do really quickly is kind of shed you probably of the trading methodology that you're using and open your eyes to a slightly different methodology that I'm telling you can make you profitable. Now, respecting volume profile of generated areas of support and resistance is critical and a fundamental component to successful trading. And what we do is we create dynamic SR volume zones. And they will, if you respect them and just a few other trading rules, they'll make 75% or greater of your trading entries winners. I'm going to show you how we put that together. Now, I call these the three core trading principles, and you can call it secret number one because nobody seems to do it, but you'll see that all of these seem very reasonable. First is that SR, and that's just support resistance. Volume zones are dynamic, and they must undergo constant adjustment. Now, there are other platforms that create volume zones, but they don't. But they're either not dynamic or they don't recalculate intra-candle, and they must do that. Remember, volume zones are created off a volume profile, which is a component of market profile. And volume profile is constantly changing. Even as a candle is evolving, the volume zones are changing. And if the volume zones you're trading are not constantly moving along with volume profile, then they're never accurate. And what can happen is if they calculate at candle close, they can jump right in front of your trade and cause what was a great trade to immediately become a bad trade, because an area of volume resistance can right into your trade on a long trade. And another thing that a lot of volume profile and market profile traders seem to create is they create areas of support and areas of resistance. Support's in blue, resistance is in red. But there are no formal zones of support or resistance. When resistance breaks, it becomes support. And when support breaks, it becomes resistance. So these areas are not really fixed support and resistance zones. You'll see what they are is they're areas of price rejection. So they're rejection zones. Now, you'll see how we create them and why we really call them zones of rejection. They act as support and resistance, but that's a constantly dynamic process. And we'll also show you how to use volume zones to tell you when to pull the trigger and really start making money, start racking up profit, and start taking money from the other small commercial traders that are out there who are just doing it wrong. Now, I'm sure everyone's seen this as volume profile. And what you can do is you can create multiple volume profiles on a chart. You can have one for the daily volume profile, one for the weekly, one for the monthly, one bi-monthly. But it gets very, very confusing if you use multiple volume profiles to try to trade on a given day. It's much simpler to do a look back on a single volume profile that takes a proprietary number of look back days to give you the volume profile you look at a little more stability, but yet still keep it nimble. But this is the volume profile, and all it is the volume accumulated at every given price on your financial instrument. Now here's just another look at volume profile, and you can see that here's the area, here's the histogram where most volume at price is traded. Now, it doesn't make any difference what this instrument is, but at 2021.75, probably the E-mini, you had the most volume trade. And then here's a very critical area up here. I'm not going to go into exactly what they are, and here's a critical area here. Now, this is just the volume profile for one day. It really doesn't give you the stability and the precision that you need. What you want to do is accumulate data from a proprietary look-back number of days. And that's what we've done. Now, what is volume profile based at? And the reason I like volume profile so much is it's really based on math. And what it does is it takes the amount of volume traded in a given period of time and breaks it up into one standard deviation, which is 66 2/3% of all the volume traded at price in any given day. And based on that parameter, it creates areas of support and resistance. Now, we look at a different number. We've looked at 66 2/3%, which is precisely one standard deviation, but we found that volume profile, based on a slightly different number, provides better areas of support and resistance. Now, remember that anything outside of one standard deviation is going to be difficult to achieve. It's hard to get out into the tail, and it's hard to drive out into the tail here. Volume and price want to stay right here. And to drive out into this tail, you're going to see takes work. Now here it is again. Now this is a little bit of Russian. I didn't mind having this on the slide because I really like the way this portrayed volume profile. And what you have is here's, in a perfect world, volume profile would have the distribution I showed you. It would be normally distributed with one standard deviation encompassing 66 2/3% of volume, or right in there. For us, it's closer to 70%. And it would be, again, normally distributed. It would be perfectly symmetric. Now, the way that the market trades, it winds up not being symmetric, but the same principles still hold and are still operational. Now, the line, which encompasses the higher area of that 66 2/3% normal distribution, is called the value area high. And the area that encompasses the lower border of that standard distribution of one standard deviation is the value area low. And the one price in which most volume is traded is the point of control. And these three lines are very, very critical to trading, because traders have made it such. They want price to be at the point of control, and they want to trade it there more often than any other price on the chart. That's where more volume has crossed. And the value area high and the value area low encompass one standard deviation of volume for the given day. Now, here's our volume profile. Now, you can see it's composed of two lines, but I only want to get into one of these lines right now and just show you that here's the histogram. Now, we don't rely much on the histogram, because what we rely on is the indicator creating lines of support and resistance for us using it, so we don't really leverage it any more than that. And you can see, if it was normally distributed, the point of control would be along this blue line. But it's always skewed, and that's okay. One standard deviation is encompassed between these two magenta lines. The magenta line down here is the value area low. The high magenta line is the value area high. We're going to talk later about these orange lines, because they are also critically important. And the point of control is the black line. So the data is not exactly normally distributed, but between the value area high and the value area low, you do have 66 2/3% of all volume traded at price. And you can see that $53.49 is the price that most traders favor crude oil to be. And these create very important areas of support and resistance. And I'm going to go into that a lot more. Now, here's where I labeled them. Now, this is the value area low. Here's the value area high, and here's the point of control, where most volume is traded at any given price. I just want to look at the... Now, here's the thing that's very, very important to know, that the value area low, price is repelled. At the value area high, price is repelled. And the reason is that traders have created what they consider to be fair market value for the instrument you're trading. In this particular case, it is crude oil. And price does not want to rise above fair market value or rise below fair market value. Because of that, as price approaches the value area high, it gets pushed away. And as price approaches the value area low, it also gets shoved away. So you have two areas that repel price. Then on the other hand, what you have is the point of control, which attracts price. That's the area where most volume has traded at any given price on the chart. So within volume profile, and this is really volume profile now creating market profile, you have your two value areas, high and low, pushing price away towards the point of control. Now, market profile is dynamic because volume profile, which determines it, is constantly changing, and it calculates market profile intra-candle. And again, I mentioned it previously, but that's incredibly important. And you can see that there are two additional lines on this chart. And those additional lines are really what make market profile, what make this market profile so powerful. And I'm going to show you how those come into play. Now, the value area high, value area low, and point of control are definitely very critical towards trading. I don't think you can really trade without them. And I traded for years without them and always wondered why there were some trades that just failed. And I believe it was because I was trading into areas of, I was trading into the value area high, value area low, or point of control and not know it. And there are ways of making market profile even stronger. Again, that one component is making sure it's dynamic and recalculates intra-candle. Now, within each volume profile, there are multiple low volume nodes. Now, by definition, the value area low or the value area high does not have to be a low volume node. There can be a decent amount of volume at price at the value area high and at the value area low. These lines are created simply by that one standard deviation of volume. It does not matter how much volume is traded at this particular price. It doesn't matter how much volume is traded here. The point of control is all based on how much volume and price there is. This is the biggest histogram bar on the chart. But there are also low volume nodes in which there's almost no volume traded at price. And there are two critical low volume nodes. And it took us a long time to find out which are the two most important low volume nodes on the chart. Now there's one above the point of control and there's one below the point of control. And remember that low volume nodes, just like the value area low, and just like the value area high, are areas that repel price. Price does not want to trade here, and if you look over, there's very little volume here. And for some reason, traders have said 2346, which is this low volume node, we don't want to trade the E-mini here. So when price approaches it, it's going to get repelled. On the low volume node, same thing. Traders have determined that at 2340.25, they don't want to trade the E-mini there. It remains in fair value, but for some reason, this is an area of price rejection because so little volume has crossed at that price. And since it is an historical calculation, not just on a one-day look back, but on a proprietary number of days of look back, it has significant statistical weight. So what we've done is leverage the value area low and leverage the value area high to create what we call zones of rejection. And these are areas where price simply does not want to trade. And it takes the difference between the low volume node and the value area high and the low volume node below the point of control and the value area low. And price really desperately does not want to trade in between these two areas. Now, right now, this is a zone, depending upon where you're looking at the chart. Up here, this is a zone of support. Once it's broken and retested, it becomes a zone of resistance. And as you move down here, this is a zone of support. Eventually, all zones of support and rejection, zones of support and resistance ultimately will get broken, and then it changes into a zone of upside resistance. So you see that these zones are not static and can't be colored red or blue because support zones get broken and become resistance. Resistance zones are broken and become support. We just know that these are zones that price is going to reject. And depending upon where we are on the chart, they act as strong areas of support and resistance. Now, here's what you see on other charts. They create fixed areas of resistance fixed areas of support. They're colored blue and they're colored red. And you can see why that's simply just not accurate. That these zones change in nature depending upon price. And so you can't color a zone red or color a zone blue. It's either blue or red acting as support or resistance depending upon where your price is. And again, an essential component is its intrabar dynamic properties. Now there's one more component of market profile that's extremely important, and that's called the volume ladder. And we use this as well. Now the volume ladder, on this they're all zero, but the volume ladder creates above it a delta. And you can see right here the delta is 8. And what that is a buy-sell imbalance. That so far in the creation of this candle, there are 8 more sellers than there are buyers. And this creates a delta moving average. And you can see that the moving average is just slammed red based on this 1.8 number. Now, just like our market profile, this market profile doesn't accumulate the delta for each candle, nor the moving average delta, because NinjaTrader, which is the platform that we're active on, does not store this data. So this is going to start to recalculate brand new every single day. Now, we could have created an indicator that stored the data, but when we did, it used up so much system resources and made the indicator so code heavy that it just wasn't worth it. So when you open up the indicator every day, this is only going to be active on the right edge. And that's the way most of them work. Very few of them store this data, and I don't believe it's really necessary to do it. Now, here's the important thing. What we did was, and here's what we do accumulate, because this does a look-back period of time and creates a line. And this is something that nobody else has ever done. What we do is we look at these numbers, and what we create is a moving average. And this is our volume profile. I'm sorry, this is order flow. I don't want to confuse you by confusing myself. This is our order flow component of the indicator. But what this looks at is the moving average of the delta of 2 higher time frames. It doesn't look at the delta on your trading chart. So each number above the candles here are irrelevant. What's relevant is the number above the candles on your 2 higher time frames. So this line is green or blue, not because this price is moving up. Price is moving up because this is green. This line does not look at price movement on your chart. It looks at price movement on your higher time frames. And it creates a bias for you. I'm going to show you how well that works for you. It doesn't give you an entry, but it gives you a direction. And this is the direction created by the institutional traders. Now, the commercial traders are going to trade in the wrong direction here. We, as commercial traders, are going to trade in the direction of order flow. So for this period of time, we're only going to look for a long trade. During this period of time, we're only going to look for a short trade. The reason being, we want to trade in the direction of our 2 higher time frame order flow direction. We want to trade short when there's an overabundance of sells orders. We want to trade long when there's an overabundance of buys. And since it looks at two higher time frames, when both higher time frames are moving to the upside, you're green. When the longest time frame is moving to the upside, it's blue. So remember, the longest term time frame rules in direction, but the strongest areas are when you have green. When you have red, your two higher time frames are moving to the downside. When only your longest term time frame is moving to the downside, you have orange. So the strongest is when it's red. But the longest term time frame still rules, so you can trade short whether you have red or orange, or long when you have green or blue. But don't counter trend against the direction of this line. Now here is the volume ladder. And here in the candle, and you'll see we do this as well, because we want to leverage volume profile we want to squeeze out of it all the information we can. Now this is a candle in which there's a tremendous, at this tick level, there's an overabundance of buys. And so this level has a blue line through it. And you see, when you see this work intra-candle, you'll see how dynamic it is. The blue can be there, then it can even be red. Then there can be blue. But ultimately, when this candle prints, it's going to have, and this is a green, this shows an even stronger overabundance of buys. Now, does this tell us that price is going to continue to the upside? It does not. This whole candle can be dark green, showing there's an immense overabundance of buys, but it doesn't guarantee a continuation trade. Here's what it does do. When price comes back in the other direction on the sell side, you have to be careful because you know that there are a lot of traders here on the buy side, and they may overwhelm the sellers here, and they may create an area of support. And it's the same thing here. And this is the way this footprint, this volume ladder, is used. You cannot use it to guarantee a long trade. And in fact, in a trend that continues to the upside, the highest tick may even be red. There may even be an overabundance of sellers in that one single tick. But you'll see that price continues to the upside because the delta is green. And overall, in the candle, there's an overabundance of buyers. But be careful on this tick level when you come back to it. And we're going to go to trades. So it'll all fall into place. And this is all done intra-candle. This color could change 5 times as the candle is formed. That's why you can't use it to trade, because you don't know the color that it's ultimately going to be until the candle prints. And it does not guarantee a continuation. Now, this is a really bad JPEG of actually the way our candles look. I don't like it, but you can see at the bottom of every candle, there's a green tick level telling you there's a nice overabundance of buyers here. Now, here's a nicer one. And I'm going to show you much, much nicer ones. I mean, here's price. There's an overabundance of buyers here. But look down here to order flow. Order flow here is yellow. You're not going to trade yellow order flow. It means your 2 higher time frames are moving in opposite directions or flat. This is a period of time where you don't trade. And here order flow is red on both higher term time frames. You're looking for a long trade, not a short trade. So the overabundance of buyers in this particular tick level don't give you a direction. Here's your direction. Now, let's take a look at some trades. Now, we're not going to use the volume ladder or the inside the candle on these trades because they only provide additional tiny areas of support and resistance. But I want to show you how to trade order flow and to trade zones of rejection as areas of resistance and support. That's the important thing. Now you see price comes right down to support. and you look down, and order flow is blue or green. So you know there's an overabundance of buyers. You're going to take a long trade, one tick above the close of this candle, and it's going to take you 7 ticks. It's not a big trade, but it's a winner. Price comes back to support. You look down, order flow is green or blue. You take a long trade, one tick above the close, and this one goes 9 ticks. That's a better winner. And these do not act like pivots. Every time they're hit, they weaken. These stay just as strong as long as they're present. When volume profile changes and these areas move, that's when they become non-existent. As long as they're there, they're just as strong. When it's hit the 3rd time, you look down, and now order flow is green. Your 2 higher time frames have an overabundance of buys. You're in 1 tick above the close, and here the trade goes 31 ticks. Now, when you reach a high, you want to be very careful when you counter trend trade. And you can see on this high, if you look down, order flow is still green. When you look here, order flow is now red. Now you're trading in the direction of the institutional traders. They have created an overabundance of sell orders on your 2 higher time frames. You're at a zone of rejection created by volume profile to the upside, and you're in short here, 1 tick below the close, and that's a 33 tick trade. Now what you're looking for here, when this zone is broken finally, is a move back and then a rebound off of resistance. Here it was acting as support. Now it's resistance. We just don't get that yet. But we're always trading in the direction of multi-time frame order flow. Now here's another trade. Now, would you take this long trade? And the answer is no. Even though it worked, you have to adhere to your rules, and when you trade with specificity and not sensitivity, you're going to find that there's some great trades off support and resistance that simply you can't trade because you must trade in the direction of multi-time frame order flow. So this long trade is not a trade. Can you counter trend trade this resistance trade? This is a nice engulfing candle. It shows a lot of selling conviction, but you simply can't trade it because order flow is to the upside on your 2 higher time frames. It's too risky and you may get stopped out. The same thing with this trade. You have a pull down to the point of control and a pull back to resistance or a zone of rejection and a nice engulfing candle to the downside. Now you can trade it if you understand the risk. You're trading into support, which is the point of control, and you're trading against a direction of order flow. So you just don't do it. Then price breaks market profile, comes back to resistance of the point of control. Order flow has now changed. And look at the trade you get. 1 tick below, you get 61 ticks. And what makes this a low probability entry is you're trading in the direction of order flow. This is a high risk entry. This is a high risk entry. And this is a high risk entry. Now, high risk entries can be winners. But what we want to do is what we strive to do is to create entries that are as low risk as possible. And I purposely pulled this out because I wanted to show you that some entries that develop are simply not tradable entries. That you want to trade in the direction of multi-time frame order flow all the time. And if you do, you're going to stay on the right side of the market. And that's the most important thing. If you have to let 3 high risk entries go to get a real low risk, huge winner, that's what you're going to do. And that's the biggest mistake that day traders make. They don't adhere to all the trading rules. We know this is an independent predictor of price movement. And since we know it predicts price movement, we've got to trade in the direction of it. Now, eventually it turns, but it just hasn't turned in time to get us into the trade. And once the trade lifts off support, it's gone. We can't chase it because it can always come back to support again, and in doing so, stop us out and then continue up. If we can't get in on the entry candle, we got to let it go. If volume profile hasn't changed in time, we have to let it go. But you can see eventually volume profile does, or order flow does rotate, and down we go. Here's another trade. Again, now here's where price is inside that zone of rejection. It's still acting as an area of resistance to the upside. Now the only thing that breaks it by Japanese candlestick dogma is when there's a two-thirds candle body close above this zone. Now this candle, if you wanted to take the entry, is a higher risk because it hasn't technically broken that zone of resistance. Two-thirds of the candle body is still inside it. But you can see you've got green order flow. So this is an entry that you can decide on. It's a good entry because it's the candle after the retracement. And here's the continuation. And what we learn in trading school is this is called a piercing candle. The body of this candle pierces two-thirds of the body of this candle. So you have a nice entry and you're trading with multi-time frame order flow. So you can grab it, but it's slightly higher risk because you haven't broken the zone of rejection. If you want to enter here, you can enter here. Now, if you entered at the more conservative entry, you still made 27 ticks without a pullback candle. And that is if you're trading 4 contracts on this is crude oil, you get 27 ticks depending on your ATM, your automated trade management strategy. This could be between a $300 and a $500 trade, and that's all you need to give yourself an incredibly great day in the market. If you take 2 contracts off at your first target, 1 off at your second, and 1 off at your third, you've made yourself a really, really nice amount of money. You don't need more than this. So that's why you stay conservative, go with your rules, and you're good. Now, there's one other thing I want to mention. When these zones of rejection are narrower, it's when they're stronger. You know, the one thing that we always stress about with pivots, and we stress about with moving averages that act as good areas of support and resistance, is how strong are they, how weak are they? Well, the moving average doesn't change. If it's a 50-day, it's weaker than a 100-day, which is weaker than a 200-day. But off of volume profile, we can get an assessment how strong the area is, because when the low volume node is almost confluent with the value area low, this is a very strong area of support or resistance. The smaller the zone, the tougher it is. As these zones get wider and the low volume node splits off from the value area higher, the value area low, the zone gets a little bit weaker. But it's still very, very dangerous to trade inside them, which I would never do, or trade into them, which I personally would never do either. Because what happens is the market just runs like crazy once you get above them or once you get below them. It's like, it's almost, I don't know, it's like you turn on it's like you energize the market and it just flies. You just have to wait. Now, you can trade in between them, but I'm going to show you on our platform. You know what? Let me open that right now. I'm going to come back to the slides, but I just want to open NinjaTrader, and then we'll go back to it. Just get it going. Let me go back to the slides. Because I want to show you what you see on our charts. Now, here's the trade we had today, and we took today in the market. Now, the background bias is green, and that's another indicator that I didn't mention. But I had to draw the zone of support here because the zone of support had already moved. And I know that may be confusing, but this support zone wasn't present when I went back, because remember, they're dynamic. And you're going to see how we work them on the chart. They just don't sit there. As you take a day and you scroll, you're going to see that zone moving up and down. But this is the way the zone was when we took the trade. We let it break the zone, retest it as support, and we took a C candle, and it went 6 points on the E-mini. And you can see the volume ladder had an area of sell imbalance here, strong buy imbalance here, sell imbalance here, overabundance of sellers in this candle here. But that does not make any difference on the movement of price as we move up. What it does is it affects a long trade when you're moving into an area where there's a lot of sellers at any given tick level. So we don't use this to trade. We use it on the counter trend move to try to determine whether this tick is going to break or hold. Let me just drop these down. This is also something else that we have. This is our dashboard. And just let me drop these. And drop this one. We're not going to see much market movement right now, unfortunately. And I want to show you another area that we had today. And I'll show you when we quit. Now, this is when we quit the market. And what we had was, and this is real time, we had price bracketed by 2 zones. Volume was terrible. You could look at order flow. It's green, it's yellow. It's green, it's yellow. It's green, it's yellow. And price is bracketed by upside resistance and downside support. And when it gets closed in like this, so here's the point of control right here. So in order to take a trade, the time was about 11:30, 20 to 12 Eastern time this morning. And this is really what you saw. On a down move, there were overabundance of buyers on these ticks, at these tick levels. And here there was an overabundance of sellers, and move right to an overabundance of buyers. That's the way the volume ladder inside a candle behaves. But we could see trading here, order flow is on and off, and we're stuck. We're not going to take any trade anyway, because to the upside we've got a big zone. To the downside we've got a big zone. Remember, these are weaker zones because they're big, but they're still tough to penetrate. And so based on that, we just quit the day. That's the end of that 6-point move coming up right here. And I knew there was going to be a retracement after it ran 6 points. What I was doing was just determining if we could catch it, but we just couldn't do it. We could not catch it. Here was the high candle. Order flow hadn't turned yet. And we just couldn't get the move. So, you know, the market just doesn't always do what we want it to do. And when it doesn't, we just step aside. Now, I'm trying to see what I was... Oh, here was a nice move up. And I had to put this blue line in, unfortunately, but you'll see it on the charts. And you can see here, there was an overabundance of buyers, and look at order flow. Green, blue, very strong to the upside. Your bias throughout this whole time here is you're going to take a long trade. Going to take a long trade. All right, so let me move over to the charts just briefly and show you what you see, because I think that's the most, and here's what you're going to see. Now, here's the way we make it. Now, first of all, let me take this off. Now, there's a lot of, this is the full platform, and there's a lot of things on here that are going to be confusing to you, but I want to show you what's critical on the market. And that is right now, here are the 2 zones. You see this gray zone here? Here's your upside zone of rejection. That's resistance. Here is your, now I want to show you what happens because this is dynamic. When you move to the right, well, I'm going to show, now here's that 24 tick trade right here. With 6 points, 24 ticks right off of this area. Now if you move to the right edge, you're going to see, you see how it's, there's a zone there now? It's sitting right there. But that zone isn't there. Let me fix this. Right here. But as you move over, the zone disappears because it's dynamic. And it keeps changing the exact area that it is. I want you to see a real chart. And the only place that the zone is accurate is on the right edge. That's the only place. If you scroll to the left, you have to go to the right edge, right here, and you can see the zone called the top. And I'll show it to you right here. This was the zone in real time here. No, it's here. There's the point. There's the value area. There's the low value node right there. But if you look at order flow, it hasn't changed. It doesn't call the top. Right here. It's this bottom line. The upper line is multi-time frame momentum, and these three lines are something else entirely. But this indicator did not call a top using order flow, so we can't trade the top. And you see what happened to these traders. I don't want to get too complicated, but these traders called a top when order flow was still blue, and then it turned green, and they got run over. These traders got lucky, and this was a top, and eventually order flow changed, but it just didn't work so that we could catch the counter trend move. It's unfortunate, but it just didn't work. And then as the day progressed, we got stuck with those two zones. And right around 11:30, we had those two huge zones bracketing right here. Here's how the zones were when we closed. And again, we got to draw them in because they're dynamic. There was that zone I showed you on the slide, and here was that zone to the downside right here. Zone is here, and the zone is here. Right here. And you'll notice that I don't even have the histogram up. I turned the histogram off because I don't really care about the histogram. All I care about is the data that the histogram provided. So you see that price is bracketed here. So we just stopped trading, and we can see how it works. But now price is moving into the zone, and it breaks it to the upside. And the bottom line, order flow turns green. And price goes up. Just very difficult to trade in the afternoon. That's the whole afternoon in terms of volume. Crude oil, the same way. We had nothing to trade on crude oil at all. Absolutely nothing. This is 3 o'clock in the morning. When we started at 9 o'clock, there wasn't a single trade that we could get on crude. But we trade with incredible specificity. We want multi-time frame order flow to be in our direction. That's this lower line. And we want to leverage these dynamic zones of resistance or rejection very, very carefully. Now, I want to put the slides up really quickly. I think this is the single most powerful indicator that we have on the chart. Now, this is multi-time frame momentum. It's not part of this indicator because it's not volume based. But a lot of times they're in opposite directions. And when multi-time frame order flow is in one direction and multi-time frame momentum is in the other direction, it's a great time not to trade. Because what you want them to do is to be together. like on this trade we took, on this trade entry, what made this such a low-risk trade. And listen, day trading is not about getting winners. It's about avoiding losers. Look at this winner. You have order flow, multi-time frame, green. Momentum multi-time frame, green. Forget these lines because we're not really going to talk about them. Background bias is green, which is really important. And we know we're trading off of this zone of support. It's just not there right now because it's not the right edge right now. And the trade goes up. I mean, if you're going to get one trade in one day, it isn't bad to get a 24-tick trade on the E-mini. You don't see many of those. But that's how far it went. And I'm telling you, what happened is, once it broke that up, it sat on top of that zone of support right here, and it just runs. Because it's got no upside resistance as far as volume profile is concerned to hold it back. And it ran through everything and went 6 points before we got a reversal candle. That's a huge trade on the E-mini. And we just got that this morning. So let me go back to the slides. And then I'll answer any questions you have. Let me just go down to the bottom slide. And what I want to do is I just want to show you what we're going to do as far as selling you the indicator. Let me go through this. And we really have spent an enormous amount of time on working on it. Now, if you buy before midnight, we throw a lot of things on there. The first bonus is you get 3 months in the live trading room. So you're going to come in the morning with me. I trade every morning from 8:45 until 11:30 or so, and you can watch me take all the entries. And also, what you get are, let me just switch down to this number 3, you get 12 didactic sessions. The didactic sessions are Wednesday afternoons after we finish trading. And they last an hour and a half, sometimes 2 hours, if there's a lot of questions. And I teach you how to use all of the tools on the trading chart. Now for the trading school, we charge $4,000. Just for the didactic, we charge $1,000. And you get all 12 of them. And then the NDT is our trade execution platform. I didn't talk about it, but you get that for 3 months as well. You also get access to our tutorial library, which is $599, and you get chart templates. And we'll create chart templates for you for over a dozen different markets. Like we trade the E-mini, and we trade crude in the room. Our algorithmic systems trade gold, they trade the NASDAQ, they trade the 6E, they trade bonds, they trade notes. But if you want to trade the Dow, if you want to trade any other markets, we'll create a template for you. So all you got to do is stick it in, and you're good to go. Since it's a multi-time frame analysis, we can teach you how to put the inputs in yourself, but it's a lot easier if we put them in for you. If you want to trade a 4-hour chart, if you want to trade a 2-hour chart, or a 1-minute or a 3-minute, all of this is still relevant. I know someone's going to ask me, does it work on time, tick, Renko, and range, and tick charts? It does. It does not matter. These principles that move the market are good, and it doesn't make any difference what kind of chart and what kind of time frame you're trading or what it's in. It works great on stocks, and it works great on the Forex. So normally the indicator alone is $9.99. The bonuses are $27.93. I don't know how I got the total value. It's $26.94, but it's $799 for the indicator and all the add-ons if you buy before midnight. And if you buy after midnight, you just get a little bit less of an add-on. It's still $7.99, but you only get 1 month in the room, 1 month NDT. The 1 month in the room gets you 4 didactics. You still get our tutorial library, and you still get all the chart templates that you like. So you get a lot longer time if you buy a little bit earlier. So let me just take a look and see if there are any questions. Oscar, can you put the link in the room? Okay, so hang on. Let me see if there are any questions. Okay, there are. So hang on. Yeah, they do, Mike. They have expanded their business. They do make obviously, you know, that they're famous for their tasers, and they're famous for their for the cameras that they have on police officers. They also now make cameras for drones, and on a drone, that's a taser camera. GoPro, you know, makes the cameras that are used recreationally, but the defense contracts and the defense cameras go to taser. No, I wish it was, John. John's asked me if that was my home. Charles, in the Forex, there's still a buy-sell imbalance, and it works a little bit differently, but it's still operational on the Forex. I agree with you. I would have to show you how the Forex markets work. There's a little bit less data on the Forex, and it's harder to make a volume profile. You're absolutely correct. But you still can make zones of resistance created by order flow, and there's still a buy-sell imbalance created at every tick level there on the Forex markets. But you're absolutely right. Forex is a little different, though. And the BM, the indicator works fine in minutes. I just prefer range, and the reason I do, and I traded tick charts for years, is because I like to know the close of the candle before it closes. I mean, it gives me an idea of where it's going to close. Now, with the NDT execution platform, it doesn't matter. You're going to grab the close anyway, but it's really just my preference. And for me, I believe that range creates a really nice market structure for me. I mean, I'm a very big market structure proponent. Now, you can get an engulfing candle with a tick or a time, any kind of chart. But I just really like, you know, it's just my preference. I'm not going to tell you that it's any better than tick or time, but I don't know, after many years now, I've really become an adherent to range, because I like the way it creates market structure for me to read. And market structure is a very important component, I think, of trading. Thank you, Hala. I appreciate it. We define our targets. What we do is we have an ATM for each instrument. For crude, we take two contracts off at 5, one contract off at 10, and one contract off at 20, and we're on a trailing stop. So our maximum upside is $400. Our maximum downside depends. We're out on a reversal candle. So if it goes 3 or 4 ticks in our direction, we take a much smaller loss on the trade. So that's how we define it. On the E-mini, we trade 4 contracts. We take 2 off at our first target of 4, 1 off at our second target of 7, and 1 off at our third target of 11. So our maximum upside on the ES is also $400. The amount of money we lose depends on how the trade evolves, because we're also out on a reversal candle. So if it just misses our first target, comes back and creates a reversal candle, we lose way less than we could have potentially lost at the beginning. So it really does limit our losers. So we don't have a 1-to-1 risk to loss. We have about a 1 to 0.5 or 0.5 to 1 risk to loss. No, BM, the phone number is optional. So you should be able to do it. If for some reason you can't, just put your email address into info@rightlinetrading.com, just a regular email, and just say, please send me, please sign me up, and we'll do it for you. So don't worry about that. You can't use anything other than NDT. We're just about to get onto Sierra, but right now we're on NinjaTrader only. Michael, if you want to scalp, listen, scalping has nothing to do with your entry. It simply has to do with how much you want to take on the trade. So you're willing to take a much smaller amount on the trade, but your trading entries still have to be low risk, high reward, because you don't want to lose on a scalp because your margin is small. And the reason that scalpers have such a hard time is they'll take 5 winners and then a loser is going to hurt them. So the entry would be the same. It's all based on your ATM. You're going to, if you trade 4 contracts on a scalp, you're going to take them all off at 2 ticks, 3 ticks, or 4 ticks. It's a small amount, but you still want that same extremely low risk entry. An entry where you're trading with everything in your favor, so at least it takes you out and you wind up getting all the money that you're looking for. So the system, you would still work the system exactly the same way. Listen, the one thing we can never determine is how far a winner is going to go. That's why we have an ATM. We just happened to get 6 points on the trade this morning, but sometimes we get 5 or 6 ticks, or sometimes we get 4 or 5 ticks. We just need a low-risk entry to get us there. So your scalping technique would be exactly the same as what we're looking for here, and you're going to have a very, very high percentage of winners because you're trading without going into support or resistance as defined by volume profile. You're going to trade in the direction of multi-time frame order flow. That's going to get you a successful scalp trade. Surgeon, if you're an existing owner, you get the indicator. Okay, just talk to Rory. It is, Irvin. We're programming into it now, and it's going to be part of our auto trading system. Charles, I wish I could, but I don't. The reason I don't have the time is I have to disconnect CQG and Continuum. Put up the FXCM data feed and change the whole workspace. And that's going to take me between 5 and 10 minutes to do. I'd be more than happy to show you the Forex. If you send me an email and give me a time, I'll let you log on to my computer and I'll show you the Forex system. Our ATM for bonds, Wayne, we trade 4 contracts. We take 2 off at 3. I'm sorry, 2 off at 3, 1 off at 4, and 1 off at 6. No, if you're a current indicator suite owner, Ron, this indicator is an upgrade and you get it for free. It's always our mantra, and that's one of the things I just want you to know. If you buy the indicator and we make it better or we upgrade it or improve it, you get that upgrade for nothing. We never charge you for an upgrade. Everybody who owns our software and our indicator suite, this is a major improvement of our older market profile. They get this indicator for free. There's no upgrade. But these are people who are our full owners. Lisa, it should be within a day or 2. We'll be ready to go with it. Okay? So listen, everyone, I hope if anything, you learned a lot of things from it. I try to make the webinars academic and just not, buy. I think it's a tremendous indicator. I think it's going to help you trade. But I just want you to remember to stay on the side of the institutional money. That's what the other commercial traders don't do, and that's how they get so beat up. Trade with the trend and trade with order flow, and order flow and the trend are essentially the same thing, and you're going to wind up being successful. And the only other thing I want to leave you with is use indicators that assess things on a multi-time frame basis and not from your trading chart. You don't want to look at trading chart on indicators that assess data from your trading chart. Look at multi-time frame assessments, and that's all our platform does, is multi-time frame assessment. And that's why we have, see, this is an unbelievably good entry right here. Except the problem was it's right into a pivot, which we don't trade into, and 2, it doesn't have order flow, and 3, it's 3 o'clock in the morning. So not everything works, but if you stay with your rules, this is where you're going to wind up making money. I just want to put up our phone number. If you want to give us a call, you're welcome to. It's 1-855-765-6681, and we're at www.rightlinetrading.com. You can email us at info@rightlinetrading.com if you have any questions or you want to ask anything of us. This is where we are. We've been around now almost 4 years, and we're going to be around until we all fall over and die. So listen, have a really, really great afternoon. I'm in the trading room every morning at 8:45 to 10 to 9. I trade the system, and if we stay conservative, we do extremely well. This morning, the market only offered us one low risk entry, and that's all we took, and it went 6 points on us. So have a great afternoon, everyone, and I really wish everybody the best of luck, because it's you and I. We're the small commercial traders, and there's no reason why we can't make money and beat these other guys out. Take care, everyone, and have a great, great evening. Bye-bye.